Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's look at some of the key earnings for the week starting Monday, the 26th of February. There's plenty to sink our teeth into, despite the fact that many will think that earnings season is pretty much done. That's not the case. We still have the likes of Zoom, Berkshire Hathaway, Workday on Monday, eBay, Lowe's, Salesforce, Baidu, Dell, Best Buy. Plenty to sink our teeth into. And ultimately, despite the fact that we have seen a large chunk of the S&P 500 having reported, we still do have a lot of significant names in the docket. And certainly that is highlighted here in terms of that wider view, but also the fact that, as we can see on the top left, the percentage of the S&P 500 that has reported is now up to 85%. And with the fact that most of the big tech names have reported, markets do appear to feel a little bit confident about things, in no small part down to Nvidia with their massive beat that we saw coming into play on Wednesday evening. And I'm recording this on Thursday, so we've just seen the US market open with upside across many of the US names. In terms of the areas that have outperformed, well, look, in terms of earnings, things have been relatively strong. It's the revenue side of things that have been a bit more questionable. Energy and utilities in particular underperforming expectations, but also some question marks around the likes of financials, which has been relatively changeable, consumer cyclicals, consumer non-cyclicals. But I thought I would bring up an outlook or a sort of overview from FactSet that was released last week that gives you an overview or a view of where things stand on the revenue side of things. And notably, we have seen 4% gain for revenues across the board in the S&P 500. So things are continuing to improve. Like we said, the likes of energy, utilities, materials also weakening here in terms of the absolute numbers, but really it's utilities and energies that are also underperforming expectations. So certainly it's always worthwhile looking at that big picture, because for the most part, most of these areas of the US economy continue to grow their revenues, which of course is positive for the wider outlook. One of the three names I wanted to pick for what a sort of closer picture this week is Zoom. Now, of course, Zoom had a great time of it during COVID, when suddenly this company came from relative obscurity to having everyone from your nan to your siblings using it. And all of a sudden we saw a huge boom in terms of revenues. That has come off in a meaningful manner, and we've seen that reflected in its share price. And so this business is really trying to find its feet and find its positioning in this post-COVID world. We can see in terms of the numbers, generally they do manage to beat expectations. And this is highlighted by what we'll see in terms of the share price, with the fact that generally earnings can mark the beginning of a relatively strong period for the company. So generally it's a case of markets expecting not too much and them delivering over and above that. And if we look in terms of, say, the earnings per share, which is the top section here, so we're looking for 115. We are looking for an improved number compared to the expectation last night of 109. But the past, say, 1, 2, 3, 4 occasions have all seen earnings above 115. So really they just have to remain on track that we've seen over the past year to be able to beat on the earnings side of things. In terms of revenues, 113 expected, basically expecting to see revenues flat. So it's a question of whether they can grow their margins to improve their profitability this time around. In terms of the share price, look, we've seen this stock, if we go out to the weekly time frame, essentially collapsed, but it's collapsed back down to essentially pre-COVID levels now. So this is where people are saying, well, we're not, the business isn't what it was pre-COVID. Is there a case to be had that this is relatively cheap? Well, if you look, and we can see at the bottom of this chart with the E, we can see that most times around over the course of the past year, the earnings report has actually provided an opportunity for the bulls, albeit to trade within this range that essentially marks sort of 60 up to your sort of 75s. And so we're back at those lows once again, coming into an earnings report. That provides the basis for, once again, outperformance, most likely on the earnings side, which tallies up to what we're seeing in terms of outperformance on earnings and mixed in terms of the revenue side of things. So this looks like a similar kind of story. It looks likely that they're going to beat on earnings and probably come roundabout in line or flat on the revenue side of things. And that could kickstart another move towards the upside. So it's really a question of whether we break back down through this area of support or not. 58.87 is that prior low in October. So this is definitely one worth watching out for as we head into the earnings, if only just to remain within this range, which from a historical perspective is essentially just back down to, as you can see here with this red line, we're back down to those pre-COVID lows. So maybe it's just a case that we're just going to be looking at this market being range bound for some time, and earnings, as we've seen in the past, do provide the potential basis for another period of upside to rally into the top end of this range. So a range bound market here, not necessarily the most inspiring market conditions, but if you're looking in terms of risk to reward, if you look at, say, positions from here, let's just move this here. There you go. If you're looking at this and we're looking at the bottom end here up towards the top end of here, you're looking at 3.5 risk to reward ratio. So sometimes a range can be relatively boring, but it can pay off relatively well. So we don't know if we will break down through support here, but the range holds as things stand. From a historical perspective, we're back down to those pre-COVID lows, and we're coming into an earnings report that in the past has provided a period of upside for this stock. Next stock we're going to be looking at is Lowe's. Essentially, this is a retailer, but focused predominantly on home improvement. We have seen Home Depot falter somewhat on that front, and certainly the rise in terms of interest rates does bring question marks around consumption and demand for home improvements in particular, less so for retailers such as Walmart, but Home Depot, Lowe's, there's question marks around these stocks. So are we going to see underperformance? Well, you can see here that the last 8 occasions this company has beat on earnings expectations. You can see that Q4 generally is a relatively weak period for the stock. So the decline down to 168 isn't necessarily completely out of the blue. But if you look at the Q4 last time around, 228. So this is relatively low expectations here. It's almost setting up for outperformance on earnings, as we're talking about a similar kind of picture with the likes of Zoom, and it's been more changeable on revenues, but revenues expecting at 1847 last time around, 2245 for Q4. So again, it looks like relatively lowly expectations on Tuesday for Lowe's. In terms of the share price, let's just jump onto that. We can see it here that from a weekly perspective, we're coming back up into this major resistance level, which is around your sort of 238 kind of level. We have been regaining ground from the lows that we've seen in October 2023. And so we have got a bullish trend in play. If you look back on that daily time frame, here we go. So we have got a relatively bullish trend in play. The recent breakup through resistance takes us into a new multi-month high. Near-term downside would be looking for a move below 221 to bring a potential bearish move coming into play for a deeper retracement. But essentially, you're looking at a rally, a consolidation, a sort of retracement, ABC style retracement. And now we're leveraging that to push higher because of the fact that we've taken out that first swing high, which is 221. So from a technical perspective, I would say that this stock looks relatively bullish. But of course, as we come into these earnings, there's question marks around this sector. There's question marks around home improvement. And that is reflected in the relatively low expectations on both an earnings and a revenues front. So we could see declining earnings on a year-on-year basis, declining revenues, but they beat expectations because markets aren't expecting too much. And that could provide the basis for a move towards the upside for the stock. But certainly as things stand, I think this does over the near term anyway, over recent months, look like it's setting up for a move towards the upside as it aims to recover some of the losses that we saw here back in early 2022. So near-term resistance comes in the form of this peak that we set here in mid-23, which is 237. And the final stock that I wanted to take a look at is Dell. Of course, the tech sector has really been in the limelight of late, most notably around the AI segment. Is this relevant to a computer maker that predominantly earns its money through PCs and the like? Well, yes, it is, because a lot of these companies are now starting to try and implement AI computers, AI laptops, AI desktops. And the more we gain greater functionality into these platforms, into these services and products, the more people are willing to go out and replace their existing unit. That might mean saying, hey, we've got the new iPhone or the new Samsung and the new Google that's come out. I need to replace my phone because apparently it's got this new AI thing that looks really cool. The same kind of thing looks likely for PCs and laptops. And the more that they can build in these different features, the more people are likely to renew their products. So that does provide a potential tailwind for Dell. Whether we actually see them take advantage of that remains to be seen. But certainly you can see in terms of how they perform versus market expectations, the past 7 occasions have seen them really impressively outperform, for most of those occasions anyway, really outperform market expectations on the earnings front. 173 expected this time around. Last year it was 180, so expected to see lower EPS than last year. But, that could provide the basis for us to see outperformance once again. So, these lowly expectations, particularly on the earnings front, potentially set these stocks up to do relatively well. In terms of revenues, 2216 expected. That is well down on the 2504 in this same quarter last year. So again, is there a basis for that, or are we going to see this company manage to outperform on the revenues front because markets aren't necessarily expecting all too much? In terms of the share price, let's just grab the chart. Firstly, I want to look at the weekly time frame, and we can see here pushing onwards and upwards, and in particular that Nvidia boost has really helped the tech sector. So we're seeing markets open in new territory with a break up through that resistance level here at 86.89. That essentially looks like it marks the end of this latest retracement, which we didn't necessarily know where it was going to come into, but essentially it did look like a retracement of the rally up from 67.60s. So it looks like a shallow retracement. Shallow retracements can be utilized in a different way from a deep retracement. A deep retracement you might buy on a Fibonacci level if you've got an upward trending market. Whereas if you've got an upward trending market and you see a shallow retracement, as we've seen on this occasion, so let's just see in terms of, let me just get the shallow retracement zone on. So this time around, we've seen just move out there. So it's between the 23.6 and the 38.2 fib. So somewhere between the two. So a nice shallow retracement. Now we're breaking up through resistance. So the bulls will see that retracement as an opportune moment to be able to look for longs and utilize the relatively shallow nature of that pullback to be able to set their stops. Essentially, you're looking at an upward trending market. The earnings and revenue estimates look like they're relatively favorable coming into this report on Thursday. And given the fact that this company does have the potential tailwinds of AI for them to gradually be building it in and encouraging people to purchase new machines, I think this looks relatively favorable as we head into a crucial week that sees Dell at the back end of it, providing a continued focus for the tech sector.